Bajaj Finance reports a strong quarter in line with expectations, but the stock slips 7% as the company has cut its AUM growth guidance by a percentage point from 24-25% to 22-23%.
Britannia also slumps 5% as the MD and CEO, Varun Berry, resigns with immediate effect. N. Venkatraman takes charge as the CEO in the interim ahead of Rakshit Harge's appointment as MD and CEO from 15th of December.
HEG rallies 9% following a strong second quarter. Revenue grew 23%, whereas the profit surged 75% in the quarter gone by.
Vodafone Idea surges 6% as losses narrow in the second quarter. ARPU also rises by over 1% sequentially.
CE Infosystems under pressure after a weak second quarter. Stock slumps over 5% as the EBITDA falls 30%. The margins contract 13 percentage points.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as you can see to the top of the screen, the markets are clearly a bit nervous this morning. Both the Nifty Bank are lower, and the breadth of the market is in favor of the number of stocks declining. Two big triggers in store. One is the outcome of the BR elections. We could get the exit polls later this evening, which could be making the street a little bit nervous. And the other factor is, do we get a trade deal at some point of time with the United States? So we'll keep an eye out on both those two factors, Mangalam.
Keep an eye out on both those two factors, Nigel. And, this 25,400 to 25,450 mark has been a bit of a support in the past. So let's see where that goes from here on as well. But let's, get chatting about the primary market. It's been a fairly busy period for IPOs, and this one comes in again. We have Prateek Maheshwari, who's the co-founder and whole-time director at Physicswala, as their 3,100 crore fresh issue and a little more than that in terms of secondary issue hits the street today. Thanks a lot for joining in, Prateek. It's an interesting space to be, because as Nigel and me as students would have definitely learned from a lot of the coaching centers, etc., that came by. Unfortunately, we had passed out of school before Physicswala actually was of any use to us. But, when it comes to the investment space, there were so many companies in the education space. There was, I can think of, Treehouse, Zealand, MT Educare, Everon, Career Point, and in the unlisted large space, there was Bajaj as well. What makes you confident about sustained growth and path to profitability, especially when you're asking for 10 times sales? And it's a large, good macro opportunity that everyone speaks about, but history suggests very otherwise when it comes to the education space.
Thanks, Mangalam. Fundamentally, all these companies which you have mentioned, none of them have ever seen 4-digit CR revenues in their lifetime. We are a tech company, using mobile and website technology to provide access to Hindi heartlands and tier 3, tier 4 cities of country. See, fundamentally, what we have, what makes us a unique company is, one thing is our community building playbook. Currently we have 12 crore students, on 800 different social media channels with us, so that keeps our CAC near zero, to acquire these students on our mobile application. And second thing is, we are giving highest quality education at a very affordable prices, so our average course fees is 4,000 rupees for entire year of live learning, doubt solving, mentorship, revision put together in just 4,000 rupees. For India's toughest examinations like JEE, NEET, UPSC, SSC, banking, CA foundation, commerce, everything put together. And if you see historically, we are the fastest company to reach 3,000 crores of top line, not just education, not just consumer internet. Any company who has been, come to public markets, less than 5 years, we have reached 3,000 crores of top line. And very healthy bottom line as well. Our revenue have jumped 4 times in past 2 years. EBITDA is also jumped almost 4 times in past 2 years.
Okay, all right. Hi, Prateek. Good to have you on the show. So we take your points on board, and congratulations on on developing a business, a unique business. What the market has to say, that we'll know in the time to come. But you'll have definitely put together a very good and interesting business, which will help a lot of the youth of the country. So kudos to you all. Let's understand a couple of factors then. As you said, growth has been beautiful. Cost of acquisition is virtually zilch. But what about the path to profitability? Because market appreciates a good story and a good business, but ultimately shareholders will say, where's the profit? So is the path to profitability on?
Yeah, so path to profitability is not a challenge at all. It will come very soon. See, if you see our FY24 numbers, cash from operations were close to, more than 200 crores. In FY25, cash from operations were almost 2.5 times, more than 500 crores we have generated from core cash from the operations. If you see leverages in terms of people cost as a percentage of revenue, FY24 it was 60% of the total top line. FY25 it declined to 49%. And similarly, there are a lot of leverages in marketing cost, in tech as a percentage of total cost. As well as people as a percentage of total cost will come in future. See, we operate on a mega classrooms where thousands of students study together in an AI powered live learning environment. Every additional students brings additional IBDA to us. So it's a very very unique business model where 500 online teachers are teaching 50 lakh.
Right. We understand the uniqueness of the business model, and we understand that there would be leverages accruing from lower employee costs, lower technology costs, and higher student enrollment, etc. as well. Can you give us a sense on by when you will turn profitable, and how much more can your margins expand from current levels?
See, unfortunately, I cannot give you any definite forward guidance, but path to profitability, it's very near. See, in India, there are 30 crore students, and we are teaching only 1.5% of this market. So this is a huge market, lying out there. And especially our price point and, the amazing technology stack, which we have cracked, allows us to, to capture that market. 3 years before we have ventured into, offline, tech-enabled offline learning mode as well. We are the fastest growing offline chain in the country. We have opened 170 centers in past 2 years, which is
Prateek, and that is reflective in your numbers as well. Your top line has compounded at over 100%. You are seeing some benefits of that coming into your operational performance. But what we also want to understand is you've moved from 28 stores in FY23 to about 300, offline places. This is also more EBITDA dilutive, also more ROCE dilutive, because you are opening these stores. Each of these, centers have a payback period of over 2 years. So what I'm trying to understand is, while business is growing, you will have to also keep on investing to cater to this under-penetrated market that you're talking about right now, right? So when you look at growth and when you look at your investments, put both of these things together, what could be a predictable growth rate? And I'm not asking you for specifics. You can give us a direction. What could be the predictable growth rate on the revenue and the EBITDA front be for you?
See, growth is not a challenge at all. As I mentioned, we are fastest Indian company to achieve 3,000 crores of top line in less than 5 years of the timeline. See, offline, you rightly mentioned, offline at a steady state is a 15 to 18% margin business. But I'm number 5th player in offline. My market share is less than 7%. So there's a huge headroom to expand. It will be a compounding story for next 10 years. The stores, the 170 stores which we have opened recently will turn profitable. So the second year is the year when the offline stores turns profitable, and third year is when the offline stores start generating at return of capital happens at third year. And if you see my market penetration, it's not even 7% as compared to my competition. So there's a huge headroom to expand in offline, which will give me enormous revenue growth. But at the same time, online, which is we have a market dominance. We are teaching 20 times more kids in online mode of learning than our competition. And that makes us a very unique company. My offline learning centers are linked to online. 80% of my offline admissions happens through online. So that keeps our CAG very low in offline mode of learning as well. While any center, when we decide to open, we look at our internal data. If we have a critical number of students in online learning in any pin code, we just open a center there, sends a notification to the students and bring them into offline event, and our centers get filled. So it is a very unique business model. We are riding the wave of internet and and delivering great outcomes for the students as well.
Correct. All right, Pratik, I'll tell you what. Today you have joined in, you have educated us about your business and given us some insights. And as you repeatedly said, it's a unique tech business. Next time around, we're inviting you. We're looking forward to hearing more about the numbers, the path to profitability, how much more money would you require, in the time to come to grow the business, and also the high attrition rate. We'll talk about a few of these factors. For the time being, all the best with the IPO. On listing, re-inviting you to come back on the channel. And in fact, we'll quiz you a little bit more on some of those numbers.
Yeah.
For the time being, slip and short break, come back, continue to focus on markets. Sneha Seth of Angel will be waiting for us.
Welcome back. The market now seems to have extended its cut a little bit more. When we started the show, it was closer to 25,490. Now it's at 25,450. And what's taken it lower? It's the usual ones. We are seeing extended cuts on Bajaj Finance, Bajaj Finserve. But ITC too has taken a leg down, currently at the low point of trade. And we are seeing some selling in Axis Bank as well. Good time to bring in Sneha Seth, who is the derivatives research analyst at Angel One, joining in with some picks. Sneha.
Now, if you look at the market today, we have seen some profit taking, and the IT pack has been showing some strength in last two sessions. So I believe one counter which I'm liking at current level is persistent system. Now, if you look at this counter, after a strong move, this counter was consolidating. Finally, it has managed to surpass its resistance zone placed around 5,950. So I believe we can see follow buying coming in this counter because the previous up move was supported with volumes. So I believe one can go ahead and long this counter for the target of 6,200. Stop loss can be maintained around 5,870. Apart from this, the another counter which I'm liking is from banking space, that is IndusInd Bank. Now here the chart structure looks quite good over here. After a long time, this counter has managed to surpass the 20 demo on the weekly chart structure. So I believe we can expect further upside over here. So I would recommend buying this counter with a strict stop loss of 507, and the target expected will be around 850.
Okay, all right. Good to see you in Sneha. Thanks for those picks. But tell us on the index itself, on the Nifty, we're down 120 points. We're approaching the lows that we saw last week, which was ballpark 25,300. You think we are in for a bigger correction from here? And what are the levels you're looking at?
So overall, if you see Nifty, what move we have seen, there was a resistance, the rising trendline resistance, which was placed around, say, 25,400, 25,300, that zone itself. And the counter, Nifty managed to surpass that. Now we have seen some profit taking. So I believe 25,300, 350 should be acting as a support. And on the higher side, 25,700 is the resistance zone. So this is the range for Nifty. Looking at the overall structure and especially the FI's activity, wherein the long short ratio is around 30. So I think it is quite oversold. And if we see some buying interest coming in from the FI's front, even I would say that that would be a positive development. So as long as Nifty is managing to sustain above 25,300, 25,250, I would use this kind of a dips to go long.
All right, 25,300 and 25,250. We take that point. Thank you, Sneha, for joining in and giving us your picks and a view on the index. Let's talk about one of those index losers today, Bajaj Finance. Down 7% as we speak, closing in on the 1,000 rupee mark. Gaurav joins in. Gaurav, what is it that the street did not like so much? It was an AUM cut of just 1%.
Well, as when we look at the numbers, actually numbers are in line. In fact, the profit net increased almost by 24% on a year-on-year basis. But let me take you through some numbers. What happened is that, remember, Bajaj Finance is one of the key players of who was expected to be beneficiary of GST cuts and rate cuts. And AUM growth guidance that they had given earlier was at around 24 to 25%. Now they have cut the guidance to 22 to 23%, and this is specifically because of the MSME and the mortgage segment. In fact, in MSMEs, they're expecting just 10 to 12% growth on a year-on-year basis for FY26, and that is something which has dragged the AUM growth guidance. Apart from that, when we look at asset quality, now gross NPAs and net NPAs, although they have moved an inch higher on a sequential basis, but management said that this is because of the difference in number of days. But even on a year-on-year basis, when we look at gross NPAs, they have increased almost by 18 basis points, and out of these 18 basis points, 6 basis points of increase is attributed to MSME. So specifically, they are calling out for some stress in the MSME segment. In fact, they are also saying that almost 25% of their unsecured MSME is something where they have slowed down their portfolio. So, and at the same time, credit cost. Now they are guiding credit cost to be at a higher end of the guidance that they have given of 1.85 to 1.95%. That is something which is actually concerning the street, because Bajaj Finance, if you look at the stock price and the valuation, it trades somewhere in the vicinity of 5 times price to book. So definitely at that high valuation, if there is some slowdown which is indicated by the management, there is some caution which is shown by the market as well. And as a result, when we look at the stock performance, it is down more than 7% today.
Okay, all right, Gaurav, thanks a lot for that. Well, let's shift focus to our special segment. We get a few ideas for profit from Money Control Pro. Sachin Paul of moneycontrol.com joins us to talk about a stock that is tracking closely. Sachin?
Integrated solar cell and module manufacturer Premier Energies delivered a very strong set of numbers in the second quarter of FY26 with a revenue growth of almost 20% year-on-year. This was primarily aided by a 63% jump in solar module production volumes for the quarter gone by. Solar cell volumes, on the other hand, were largely flat year-on-year, primarily due to capacity constraints. However, the company has recently set up a 1.2 gigawatt TOPCon solar cell facility, which is currently under trial lens and is expected to reach almost 80% capacity utilization in the next 3 to 4 months. The company's earnings visibility remains very strong on the back of a very strong order book, which is also strengthened on a quarter-on-quarter basis. Well, the demand environment continues to remain very strong for the company, and recently the ministry has also recommended an anti-dumping duty on Chinese solar cell imports, which should again have a very strong environment, especially for companies like solar, for the Premier Energy, which have a very strong presence in the solar cells. The company is in fact preponed its capex plan for almost 18 months and is looking forward to reach an excess capacity of almost 10 gigawatts in solar cell by the end of 2026. Well, in terms of the stock price performance, the stock price has been consolidating since its listing in September 2024 and is currently trading at almost 28 times FY27 estimated earnings. Given the consolidation in the stock price, we recommend an accumulate trading on the stock.
Okay, all right. Just keep an eye out on the bottom of your screen. City gas distribution companies will be in focus. The PNGRB has published a high-level expert committee with regard to natural gas. And they've made some crucial recommendations which have sent these stocks higher. I think we should get some of them up for you on the screen. Sudarshan has sent a few of us. They're talking about restoration of APM allocation for CNG, which is the transport segment. They're also talking about inclusion of CNG as a cleaner fuel in vehicle scrappage policy. Now, that's a big one as well. And the mandatory use of CNG in public and commercial vehicles in highly polluting areas. So explains why these stocks have moved up. Basically, it's incremental use of CNG. And the CGD company as well, they are celebrating. I think a lot of them, IGL in fact, is seeing a big spike up.
It's more for IGL than just MGL also, because, IGL has the higher allocation coming in from APM. So if that happens, then, it's a bigger positive for IGL than MGL. Definitely a positive for MGL, because the overall volumes will increase for, city gas distribution companies itself. But IGL stands to benefit a little more with higher APM gas allocation. In fact, we'll continue to track this story. We'll probably get Sudarshan to explain a little more on this as well. But for now, take a short break, come back, focus on the markets. Well, we were talking about the city gas distribution companies. Let's talk about all of them in greater detail. Sudarshan joins in with more. Sudarshan.
So in 2024, Petroleum and Natural Gas Regulatory Board, that is known by PNGRB, had formed this committee which was headed by D.K. Saraf. He is a known face in the oil and gas sector. Now, his led committee has come out with its recommendations, and committee has made some of the important recommendations, especially for the city gas sector. And if these recommendations are implemented, we have to understand that these are the recommendations. These are not the final outcome. These are the recommendations that made by committee. So first recommendation is that restoration of APM allocation for CNG segment. If you remember, in the last 1 to 2 years, APM allocation has been reduced drastically. It's reduced by almost 40%. Earlier, it used to be almost in the range of 75 to 80%, but it had first fallen to 40% after there was a minor increase, which had gone to around 50%. So he is saying that APM gas restoration should be done for the city gas. Second, inclusion of CNG as a cleaner fuel in the vehicle scrappage policy. If that is also done, the more CNG fuel can be used in a more proper way. Third, it's mandatory use of CNG in public and commercial vehicles in high polluting areas. So basically, the committee means that whatever the vehicles are running on petrol and diesel, it has to be converted in the CNG, and there should be a support from the government in the form of policy for the conversion. And next is fleet conversion mandates. It should be made mandatory for the conversion of petrol and diesel vehicles after a certain period of time in CNG. That can also be taken positive for these city gas companies. And last one is life of CNG retrofitted trucks may be extended by 5 years. So whatever the term is there as of now, the committee is recommending that it should be extended by 5 years. So if these recommendations are implemented, it would be a huge positive for all these city gas companies.
Take that point, Sudarshan. Thanks a lot for that. With that, we'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.